EPK Capital presents Daily Brief, 28th August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. Today's session was a study in contradiction. On the surface, a day of triumph for Wall Street, with the S&P 500, the broadest measure of American corporate strength, closing at a new all-time high. Yet, this record was not achieved with a roar, but with a whisper. The gains were modest, the trading volume was subdued, and the entire global financial ecosystem seemed to be holding its collective breath, waiting for a single earnings report from a single company, Nvidia. This sets the central theme for our analysis today. A market propelled to new heights by a powerful, but perhaps fragile, narrative around artificial intelligence. But the Nvidia story, as crucial as it is, was not the only force at play. Beneath the surface of Wall Street's quiet optimism, powerful geopolitical and macroeconomic currents were shifting. The United States and India entered a new, contentious phase of their trade relationship as steep, punitive tariffs officially took effect, sending shockwaves through Indian markets. Simultaneously, the U.S. Federal Reserve sent its clearest signal yet of a coming pivot in monetary policy, a move that comes amidst unprecedented political pressure from the White House. In this report, we will dissect these interconnected events. We'll start with the numbers, move to the stories behind them, and uncover what these developments mean for your investments and the global economy. Section 1, Global Market Dashboard, the Day in Numbers. To understand the complex narrative of the last 24 hours, we must first look at the scoreboard. The data reveals a clear divergence in performance across global markets, driven by the unique catalysts affecting each region. While the U.S. edged higher in cautious anticipation, Europe traded with similar restraint. Asia, however, presented a split picture, with some markets buoyed by tech optimism, while others were hit by a direct geopolitical shock. The tentative optimism in the United States was entirely conditional, hinging on a single post-market event. Europe's caution mirrored this suspense, leading to modest declines. Asia's performance was a tale of two distinct narratives. Japan and China saw gains, partly influenced by the global tech sentiment. In stark contrast, India's market reeled from a direct and damaging policy decision from its largest trading partner. Section 2, Inside Wall Street's record-setting session. While the headline was a new record for the S&P 500, the story of the U.S. trading day is found in the details. It was a session characterized by quiet gains and punctuated by dramatic moves in individual stocks, each telling a piece of the larger economic story, the anatomy of a record. The major U.S. indices all finished in positive territory, painting a picture of broad, if shallow, strength. The S&P 500 advanced by 1546 points, or 0.24%, to close at a new record of 6,481.40. This marked the index's 19th record close of 2025, a testament to the market's underlying resilience throughout the year. The Dow Jones Industrial Average gained 147.16 points, or 0.32%, to finish at 45,565.23. This was the blue chip index's second highest close in history, just shy of its own record. The tech-heavy NASDAQ Composite added 45.87 points, or 0.21%, to settle at 21,590.14. Significantly, the Russell 2000 index of smaller companies outperformed the larger indices, rising 0.6%. This suggests that the positive sentiment was not confined to just the mega-cap tech giants and had a relatively broad base. However, These modest gains masked a deeper reality. The market was not truly trading on the day's corporate news, strong as some of it was. Instead, global markets were in a state of suspended animation, paralyzed in anticipation of a single data point from one company, Nvidia. This extraordinary concentration of sentiment reveals just how much of the market's recent strength rests on the shoulders of the AI narrative, making the entire structure vulnerable to any perceived weakness in its champion. The winner's enclosure: stories of strength. Despite the market's holding pattern, several companies made significant moves based on their own fundamental news. MongoDB, MDB, was the undisputed star of the session, with its shares skyrocketing a remarkable 38%. This was not just an earnings beat, it was a powerful statement. The database software firm reported better than expected sales and profits, and, crucially, increased its full-year outlook. This performance served as a compelling counter-narrative to the pervasive fear that the rise of generative AI would render traditional software companies obsolete. MongoDB's success had a ripple effect, lifting shares of other software firms like Datadog, DDog, which advanced 4.3%. Albemarle, ALB, the world's largest producer of lithium, saw its shares jump 7.5%. The catalyst was a strategic upgrade from analysts at UBS, who cited an improving outlook for lithium prices in 2026. This optimism is rooted in recent production cutbacks in China, which are expected to tighten supply. This is a classic example of a forward-looking market pricing in a future recovery in a sector that has been under pressure. Casino operators also had a strong day, with shares of Wynn Resorts, Wynn, MGM Resorts, MGM, and Caesars Entertainment, CZR, all gaining more than 3%. This rally was also driven by a UBS upgrade, specifically on Wynn Macau, due to improved growth forecasts for the Asian gaming hub. The move highlights investor confidence in the continued post-pandemic recovery of global travel and entertainment. Kohl's, KSS, provided a positive signal on the health of the U.S. consumer. The department store chain's stock vaulted 24% after reporting strong earnings and raising its full-year guidance. In a more unusual story, Cracker Barrel climbed 8% after it decided to scrap a planned logo change. The decision followed a significant uproar on social media, which even drew a comment from President Donald Trump. This event serves as a modern lesson on the power of brand loyalty and the tangible impact of social media sentiment on corporate strategy and stock valuation. The laggards and their lessons. On the other side of the ledger, several companies declined on news that revealed the market's underlying risks. Paramount Skydance, PSKY, was the S&P 500's biggest decliner, dropping 6.5%. The slide came after Morgan Stanley trimmed its price target on the stock, citing a steep valuation and muted growth expectations following the recent merger of Skydance Media and Paramount Global. This serves as a cautionary tale about the high-stakes integration risks and valuation challenges that can accompany major corporate mergers. SBA Communications, SBAC, a wireless infrastructure company, lost 4.9%. This decline was a direct consequence of a deal elsewhere in the sector. EchoStar, the parent of Dish TV, sold a significant portion of its wireless spectrum to AT&T. This led analysts at BofA Securities to downgrade SBAC, reasoning that with this new spectrum, AT&T would have less need to build out its network with new towers, directly threatening SBAC's business model. It's a clear illustration of the market's complex web of interconnected fates. J.M. Smucker, SJM, provided the day's most direct link to the overarching theme of global trade tensions. The food manufacturer's stock sank 4.4% after reporting a quarterly loss. The company explicitly pointed to tariff-related pressure on its U.S. retail coffee division, which includes major brands like Folgers and Dunkin'. This pressure stems from a 50% tariff imposed by the Trump administration on coffee imports from Brazil, the world's largest producer. This is a tangible, real-world example of how a geopolitical trade policy directly erodes a U.S. company's profitability and serves as a stark foreshadowing of the much larger tariff story unfolding with India. Section 3. The main event: deconstructing Nvidia's earnings. After the closing bell, the moment the entire market had been waiting for arrived. Nvidia, the undisputed king of the AI boom and the world's most valuable company, with a market capitalization of $4,429 trillion, released its second quarter earnings. The stock's performance, having surged an astronomical 1,143% since the beginning of 2023, had set expectations at an unprecedented level. The beat that wasn't enough on the surface, Nvidia delivered a stellar report. The headline numbers surpassed Wall Street's already lofty expectations. Revenue came in at $46.74 billion, a massive 56% increase from the same quarter a year ago and comfortably ahead of the consensus estimate of $46.05 billion. Adjusted earnings per share, EPS, was $1.08, beating the analyst consensus of $1.01. And yet, in the world of high-stakes investing, perception is reality. Despite these strong beats, the company's stock fell approximately 3% in after-hours trading. The market had priced in not just perfection, but a miracle. The negative reaction can be traced to two subtle but critical details in the report, which the table above makes clear. The data center disappointment. The market's focus was not on the overall numbers, but on one specific segment: data center revenue. This division is the engine of the AI revolution, and investors were looking for another explosive growth figure. Nvidia reported $41.1 billion in revenue for this segment, which, while enormous, narrowly missed the Wall Street expectation of $41.3 billion. For a stock valued at such a premium, this slight miss was interpreted as a significant crack in its growth story. Guidance failed to wow. Looking ahead, Nvidia projected revenue of $54.0 billion for the third quarter. While this represents continued massive growth, it was merely in line with what analysts were already expecting. The market was hungry for another significant upward surprise, a signal that the growth rate was still accelerating. Instead, it received a confirmation of the existing, albeit spectacular, trajectory. The company also announced an additional $60 billion in stock buybacks, a move to return capital to shareholders and support the stock price. However, this can also be interpreted as a signal from a maturing company that the most explosive phase of its growth may be moderating. This paradoxical reaction, a stock falling on objectively fantastic results, reveals a crucial truth about the current market. Nvidia is no longer being judged against its peers or even its own past performance. It is being judged against a hypothetical future of infinite, ever-accelerating perfection. The bar has been set at an impossible height because the entire market was effectively paused waiting for this single report. This negative reaction to good news signals a potential systemic risk. If the undisputed leader of the AI boom cannot satisfy market expectations even with 56% growth, it suggests the AI-driven rally across the entire tech sector could be built on a fragile foundation of sentiment. A future, more significant miss from Nvidia could trigger a much broader market contagion. Section 4. The tariff shockwave, US versus India. While Wall Street was fixated on Silicon Valley, the most significant macroeconomic event of the day was unfolding between Washington, D.C. and New Delhi. A dramatic escalation in trade tensions marked a new, challenging chapter for the global economy. The policy and the politics. On Wednesday, August 27th, the Trump administration's plan to impose an additional 25% tariff on a wide range of Indian goods officially took effect. This punitive duty comes on top of an existing 25% tariff, bringing the total rate for affected products to a staggering 50%. The administration has explicitly linked this severe measure to India's continued purchases of Russian oil and defense equipment, which Washington frames as an action that undermines international pressure on Moscow. The scale of this policy is immense. According to the Global Trade Research Initiative, roughly $60.2 billion worth of goods, representing about two-thirds of India's annual exports to the U.S., will now face this 50% tariff. Carnage on Dalal Street. The market reaction in India was swift and severe. As the tariffs came into effect, Indian equity benchmarks tanked. The BSE Sensex plunged over 600 points to close at 80,180,257, while the NSE Nifty 50 fell sharply to trade below the 24,550 mark. The selling pressure was broad-based, hitting major heavyweight companies like HCL Technologies and HDFC Bank, and sending a clear signal of investor fear over the economic consequences. The anatomy of the economic pain. The 50% tariff rate threatens to make many Indian products commercially unviable in the U.S. market, with labor-intensive sectors bearing the brunt of the impact. Textiles and apparel. This sector is among the hardest hit, with total duties now reaching as high as 63.9% on some items. Indian exporters face a massive price disadvantage against competitors from nations like Bangladesh and Vietnam, who face tariffs around 31%. This poses an existential threat to major export hubs like Tirupur. Gems and jewelry. This is a $10 billion export business to the U.S. that now faces duties of over 52%. The tariffs endanger employment in critical industry centers like Surat and Mumbai. Seafood, U.S.-bound shrimp exports valued at $2.4 billion annually are now subject to total duties of 60%. This makes it nearly impossible to compete with suppliers like Ecuador, which benefits from both geographical proximity and a much lower 15% tariff rate. Other sectors. The pain extends to auto components, industrial machinery, and agricultural produce, all of which are now at a significant competitive disadvantage. The policy is particularly damaging for the micro, small, and medium enterprises, MSMEs, that form the backbone of these export-oriented industries. The administration's justification for these tariffs centers on India's purchase of Russian oil. Yet this rationale appears inconsistent when examining U.S. policy towards China, which is the largest buyer of Russian crude but has avoided these additional tariffs, while India, a key strategic partner, faces a punitive 50% rate. The U.S. recently postponed tariffs on its primary strategic rival, China, maintaining a lower 30% rate on many goods. This is not just an economic policy, it is a geopolitical signal that risks alienating a crucial ally in the Indo-Pacific. This action could push India to accelerate the diversification of its trade partnerships and creates a clear economic opening for countries like Vietnam, Bangladesh, and Mexico to capture India's lost market share in the U.S. Section 5. The Federal Reserve's next move. The themes of trade, inflation, and economic uncertainty all converge at the doorstep of the world's most powerful central bank, the U.S. Federal Reserve. Recent commentary and a charged political atmosphere suggest a major policy shift is on the horizon. The Jackson Hole Signal. At the recent and highly influential Jackson Hole Economic Policy Symposium, Federal Reserve Chair Jerome Powell sent his clearest message yet that the central bank is leaning towards cutting interest rates. In his speech, he strongly indicated that a rate reduction could occur as soon as the Fed's next meeting in September. Powell's rationale centered on the state of the U.S. labor market. He described it as being in an unusual balance and pointed to growing downside risks to employment that could materialize quickly. This concern is supported by recent economic data. The Conference Board's Consumer Confidence Index slipped in August, with the share of Americans expecting a recession within the next year rising to its highest level since the spring. Financial markets have taken the hint. Following Powell's speech, traders in the futures market increased the implied probability of a September rate cut to over 90%, signaling that a move is now widely expected. The political pressure cooker. This potential policy pivot cannot be viewed in a vacuum. It is occurring within one of the most politically charged environments the Federal Reserve has ever faced. President Trump has been a relentless and public critic of Chair Powell, repeatedly demanding rate cuts and breaking with the long-standing tradition of respecting the central bank's independence. This pressure campaign escalated dramatically with the unprecedented move by the president to fire Federal Reserve Governor Lisa Cook. This action represents a direct challenge to the institutional autonomy of the Fed. Further reports indicate that the administration is exploring ways to exert more influence over the appointment of regional Fed presidents, who are currently selected without presidential nomination. The Fed's dilemma? This confluence of events places the Federal Reserve in an incredibly difficult position. As Chair Powell himself acknowledged, the Fed's dual mandate of maintaining price stability and maximizing employment is currently in tension. On one hand, the weakening labor market data pushes them towards cutting rates to support the economy. On the other hand, inflation remains persistent, and it is being actively fueled by the very tariffs the administration is imposing on goods from countries like India and Brazil. This creates a situation where it is now impossible for the market to distinguish whether a potential rate cut is a purely data-driven decision or a capitulation to immense political pressure. Regardless of the Fed's true intentions, its hand appears to be forced. This ambiguity threatens to erode the Federal Reserve's most valuable asset, its credibility. A perceived loss of independence could, over the long term, undermine global confidence in the U.S. dollar and Treasury bonds as stable stores of value, potentially prompting international investors to seek alternatives like gold and creating instability in U.S. debt markets. Section 6. Crypto Corner, Regulation, Institutions, and Innovation. In the digital asset space, the last 24 hours have been defined by a powerful dichotomy: the arrival of serious institutional-grade oversight alongside the continued fervor of speculation and innovation. The watchdogs arrive, a new era of oversight. The most significant development is a landmark move by the U.S. Commodity Futures Trading Commission, CFTC. The regulator has officially integrated Nasdaq's advanced surveillance technology to conduct real-time oversight of cryptocurrency markets. This is a pivotal moment, signaling that the tools of traditional finance are now being deployed to monitor the digital asset ecosystem. It represents a clear step towards market maturation and a more structured regulatory environment. In a parallel move, the crypto industry itself is becoming more organized in its engagement with lawmakers. A major coalition of leading firms, including Coinbase, Uniswap, and Paxos, has formed to advocate for developers as Congress finalizes comprehensive market structure legislation. This proactive stance shows an industry eager to help shape its own regulatory future. Institutional spotlight: the rise of Ethereum. A notable trend has emerged in the flow of institutional capital. Spot Ethereum ETFs have seen massive inflows totaling $455 million, significantly outpacing their Bitcoin ETF counterparts. This shift in institutional preference is supported by increasingly bullish commentary from influential voices. Fundstrat's Tom Lee sees the potential for Ethereum's price to jump to $5,500, citing rising institutional interest, while a Standard Chartered analyst has set a year-end target of $7,500 for ETH. This suggests a potential flippening in institutional focus, with Wall Street's attention increasingly turning to Ethereum's ecosystem. Big Tech's blockchain play. The competitive landscape of blockchain infrastructure is also heating up. Google Cloud is reportedly developing its own Layer 1 blockchain, dubbed the Universal Ledger. This move is a direct challenge to existing payment and blockchain platforms. It signals that big tech is transitioning from simply providing cloud services for Web3 projects to becoming a fundamental part of the ecosystem's core infrastructure. Crypto quick hits. A rapid-fire summary of other key stories provides a broader view of the dynamic crypto space. Ripple, XRP. The company continues to expand its footprint, integrating its RLUSD stablecoin with the Aave DeFi protocol to help bridge decentralized finance with real-world assets. Ripple is also supporting the payment network TazPay in its global expansion. Solana, SOL. The ecosystem received a vote of confidence as Sharps Technology, a medical device company, saw its stock soar 70% after announcing a $400 million treasury strategy centered on Solana. Binance. The world's largest crypto exchange saw over $1.6 billion in stablecoin inflows, a bullish indicator suggesting that traders are capitalizing on recent market dips to position themselves for a potential rebound. Government and crypto. In a sign of growing official adoption, the U.S. Commerce Department announced plans to publish GDP data on the blockchain. Meanwhile, the government of Thailand is partnering with the exchange KuCoin to push forward with tokenized government bonds. The crypto market is clearly evolving on two parallel tracks. On one path, we see the construction of an institutional-grade financial system, complete with sophisticated regulatory oversight, institutional investment products, and foundational infrastructure built by big tech. On the other path, the market retains the chaotic, hype-driven characteristics of a speculative casino with wild price predictions for meme coins and the ever-present risk of scams. This dichotomy makes the space both incredibly promising and perilous, explaining the cautious yet curious approach from the world of traditional finance. Conclusion, key takeaways, and the path forward. The story of the last 24 hours is one of a global market balanced on a knife's edge. The session was defined by a fragile AI-driven record high on Wall Street, a milestone that was immediately challenged by a reality check from its own champion, Nvidia. This cautious optimism played out against a turbulent backdrop of escalating global trade wars and a U.S. central bank signaling a major policy shift under a cloud of political interference. As we look ahead, several key questions will shape the market's direction. The Nvidia fallout. How will the broader technology sector react to Nvidia's post-earnings decline? Will the market interpret it as a company-specific issue of impossibly high expectations, or will it trigger a wider reevaluation of the entire AI-driven rally? The tariff toll. What will be the first concrete signs of economic impact from the new U.S.-India tariffs? We will be watching for warnings from U.S. retailers about rising prices and from Indian export-oriented companies about falling orders. The Fed's final justification. The market has now fully priced in a September rate cut. Will the upcoming U.S. jobs report provide the final piece of data the Federal Reserve needs to justify this move, or will a surprisingly strong number complicate their decision and challenge market expectations? Crypto's institutional shift. In the digital asset space, will the trend of institutional capital favoring Ethereum over Bitcoin continue to accelerate? And how will regulators respond to the industry's growing push for a clear legislative framework? The intersection of technology, trade, and monetary policy has created a complex and uncertain environment. The coming days will be critical in determining whether the market can build on its new record or if these underlying pressures will prove too great to overcome. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget, subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.